Okay, here we are, everybody. Good morning. It is right on 10 o'clock. It's Wednesday, so it's time for our weekly webinar. Hope you're all doing well. January is almost over, moving into the year. A lot of crazy stuff happening, with the markets. So we're going to touch on that a little bit. So today we're going to talk in our financial focus portion about using retirement plans money to pay off debt. I had two questions about this recently, and one had to do with credit cards and the other had to do with student loans. So I thought it would be an appropriate topic for our webinar today. So we're going to follow our normal format. We're going to talk about, we're going to have some market updates. First, we're going to start with our Slott updates, and then we're going to talk about the markets a bit. And then we're going to move into this financial focus and to talk about this question about should I draw from my retirement plan or my retirement accounts to pay off debt, whatever that debt is. So what I'm going to actually do is when I was putting this webinar together, I created a sample client in our financial planning portal. And so I'm going to walk through that with you, and we're going to see the results of that question. What happens if I take out money to pay off this plan? It's kind of shocking. The difference was so significant. I actually had somebody else put another set of eyeballs. I had Emily Wheeler, our head planner. Hi, Emily. Put another set of eyes on this just to make sure that I had entered everything correctly. But we're gonna go over that. I had, by the way, but we're gonna go over that today. So that should be fun to see. So I just want to remind you of the goals that I have for you as the listeners on this podcast or this webinar, and that's to be inspired to make changes, to open your mind to different ideas and ways of thinking about planning and investing. Folks, we do things differently. If I hear one common thing over and over again, it's people say, I've never thought of that, or no one's ever talked to me about that before, or geez, that really looks like that can make a big difference. I'm surprised I haven't heard this before. So I am proud of that. We work hard to do things, to keep on top of things and always work on our efficiencies and whatnot. But I want you to open your mind to these different ideas and ways of thinking about planning and investing. Stay educated so you feel confident in the plan and strategies that are put in place, and stay updated so you can make adjustments along the way. And you can use this channel to stay educated and updated. Again, don't take advice from anybody on YouTube or podcasts. Advice and education are very, very different. Take all the education you can, but advice should be very, very specific to your goals, needs, and issues. And you can't do that just at a broad swath of information, or with a broad swath of information. Upcoming events starting tomorrow night. We start our first class series of the year at Rider University, and we are completely full. And in fact, we have, I think, a 38-person waiting list. So we are considering adding another night. However, if we do that, we're already full. So if you're interested in attending the Changing World of Retirement Planning class, you're going to have to wait till the next series, and I'll have that set up. I think we're going to be back in Newtown again for that series, and then we'll be out in the Villanova area. We have a movie event coming at the Newtown Theater on March 26th. That's The Psychology of Retirement, and that's by best-selling author of The Psychology of Money, Morgan Housel. A couple other things we're doing. We're with the local community. We're sponsoring a Newtown Theater wine walk on May 17th, so that'll be a lot of fun. So you can come out and support the theater, and you can see us in our sponsorship of that event. And then we're also a sponsor of Hope on the Vine, which is a Rotary event that raises money for our community. I know these are two wine events. There's really no correlation to Attleboro Wealth Management and wine. It just happens to be they're the events out there. We're getting a lot of traction on our podcast. So many of you are listening on or watching on YouTube, or just listening on YouTube. But we have this podcast that we launched some time ago called Not a Guru, and I hear that it's getting more and more downloads every week. And actually, I was at watching the playoffs, the Eagles playoff the other day, and one of my friends who was there says, "Hey, I listen to your podcast every week when I'm driving to work." So that was nice to hear. Last week we had Andy Ives on this broadcast talking about Trusts as beneficiaries to IRAs. Really, really great discussion with Andy. So Andy's from our Slott group, and you hear Andy's reports and opinions and answers to mailbags often when we're doing the Slott report. So if you missed that, go ahead and go back and listen to it. It should be now on our website, and it's certainly on our YouTube channel. And if you're on our email list, then you should be getting that email with the recording. And if you're not on our email list and you want to be, you can go to the websites up there or on the screen, attleborowealth.com. That's attleborowealth.com. And you can go to the section where it shows the webinars, and you can opt in to receive those emailed recordings. And of course, if you subscribe to YouTube, once those recordings are uploaded, you're going to receive them. So that's the best way to do it. I love to have, the ability to email you. There's a lot of special things that we do that don't go through YouTube, but if you're just interested in the videos, hit the subscribe, and if you like it, the like and notification buttons, and you'll always know what's going on with us from a video perspective. So let's jump into the Slott report. I'm going to share my screen here, and you can read along. Okay, so we have two mailbags this week. So the mailbag is when someone writes in and they answer the question. And this is from our friend Andy, who you all met or saw again last week. And this is the pro rata rule in Roth conversions. And this is from Thursday, January 16th. So the question is, my wife has two after-tax traditional IRAs at two separate institutions. We are hoping to consolidate them, then convert to a Roth in the next 18 months. She is already retired. She also has an inherited IRA from her father. Does the calculation for taxation on the conversion to Roth need to include the assets in the inherited IRA? Do assets in my IRA have any impact on the calculation? So the pro rata rule is something that makes sometimes Roth conversions of after-tax contributions, like we're talking about here, in IRAs more difficult, and there's a lot of things to consider around conversions when you have those kind of pieces in your IRA. So the calculation you're speaking of is the pro rata rule. When an IRA containing after-tax non-deductible dollars is totally or partially converted, we must determine the ratio of how much of the conversion is taxable and how much is tax-free. You cannot target just the after-tax dollars and only convert those. There is no problem with your wife consolidating her after-tax IRAs. Subsequently, when she does a conversion, her inherited IRA is disregarded for the pro rata calculation, as are any IRAs you as her spouse have. Now, let me just comment on that a little bit, because if someone has after-tax IRAs and they consolidate it like this, and then they want to do Roth conversions and they think, well, I've already paid tax on this money, now I don't have to pay tax again because these are after-tax contributions in the IRA, non-deductible contributions. That doesn't end the whole analysis. Any IRA in that person's name has to be considered in that pro rata calculation. So even though you consolidate these after tax and say, well, I'm only converting out of here, the calculation requires you to look at all IRAs that are in that person's name, whether they're before tax or after tax. The exception, of course, is an inherited IRA, and of course, an IRA owned by somebody else, even if it's a spouse. Good question. Next question. There seems to be some confusion about a 5-year rule as it applies. This is actually, the way this person wrote this is kind of funny. But there seems to be some confusion about a 5-year rule as it applies to Roth IRA conversions. I am under the strong impression that if you are over age 59 and a half and you convert $100,000 and pay the taxes due on that conversion, then that money is now available for use or withdrawal from the Roth IRA with no taxes. For example, if I am 65 and find that I need $25,000 next summer after doing a $100,000 conversion less than 5 years ago, do I have to pay taxes on this withdrawal? I already paid the taxes on the converted amount. I don't think so, but I can't find anything on the IRS website or even any articles online to prove that I am correct. So Robert wants to be proven correct. So what's the answer here? Well, Andy says, Robert, you are correct. In the scenario you outlined, there would be no taxes due on the $25,000 withdrawal from your Roth IRA. Roth IRA distributions follow strict ordering rules. We've talked about ordering rules many, many times on this broadcast. Contributions come out first, then converted dollars, then earnings. Assuming there are no contributions in your Roth IRA, if you did a $100,000 Roth conversion, then took a $25,000 distribution, that distribution would be comprised entirely of converted dollars. Converted dollars are always available tax-free, regardless of age, because as you said, you already paid the taxes due on those dollars when you did the conversion. And since you're over 59.5, the converted amounts come out penalty-free as well. Now, if you're under 59.5, when we're talking about the ordering rules and the 5-year rule, if you're under 59.5, any contributions, of course, can be taxed and penalized if they're taken out before the 5 years. But in this case, now, if this person wanted to take out more, if Robert wanted to take, let's say he did a $100,000 conversion and it had grown to $110,000, and he wanted to take out the entire $110,000, even though he's over 59.5. If he had that money or in a Roth IRA or hadn't owned any Roth IRA for at least 5 years, then he would have to pay tax on the growth, right? That $10,000. If you cross over that 5-year mark, though, the growth is also tax free. But at age 59.5 or over age 59.5, conversions and contributions can be returned to you tax-free. The issue is you may not be able to put them back, right? So certainly the conversion you can't put back, and whether you're eligible to contribute is another story. Rollovers and inherited IRAs, today's Slott report mailbag. So on Thursday, January 23rd, Sarah, who was also on this program a few weeks ago, answered these questions. The first question is, I have a large non-qualified 457 deferred compensation plan, and I am required to take distributions. I am looking to minimize taxes. Can I roll over these funds to an IRA? So the key item here is non-qualified. Non-qualified means it's not a qualified retirement account. So Sarah writes, unfortunately, this will not work. A non-qualified deferred compensation plan is not eligible for a rollover to an IRA. The next question. Hello, I had a question concerning inherited Roth IRAs. I know that in the past you have said that no required minimum distribution or RMD is required for these accounts. Does this include inherited Roth IRAs that were created prior to the Secure Act changes? There is so much confusion on Roth IRA RMDs, so I wanted to be sure. Boy, there is so much confusion, and I think, Sarah says that here. So she says, hi, Cade. This is an area of great confusion. Non-eligible designated Roth IRA beneficiaries, or NEDBs, are not required to take annual RMDs during the 10-year period. However, there are other situations where annual RMDs are required for Roth beneficiaries. Roth IRA beneficiaries who inherited prior to 2020, when the Secure Act became effective, must still take these annual RMDs. Eligible designated beneficiaries, or EDBs, who inherited after Secure and are using this stretch must also take annual RMDs from an inherited Roth IRA. So the rules are complex. The moral of the story is, work with somebody who knows the answers and at least knows where to find them. And since we talked about eligible designated beneficiaries, I just wanted to include this list that I keep in my notes every single week. So there are 5 classes of eligible designated beneficiaries. Now, the middle 2 there are sometimes combined to 4, but they are surviving spouses, minor children of the account owner, disabled individuals, the chronically ill, and beneficiaries not more than 10 years younger than the IRA owner. So they are the eligible designated beneficiary. Everybody else is a non-eligible designated beneficiary. All right, that's the Slott report. Let's talk about the markets. So some of the reports that we saw last week, so we had the leading economic index, and that decreased by 0.1% in December, but November's reading was revised up to a gain of 0.4%. The index declined by 1.3% in the second half of 2024, which was lower than the 1.7% decline seen in the first half of the year. So the leading economic index is created by what's called the Conference Board, and that's the organization that puts together the index. They noted that they expect the growth momentum to remain strong, although the index has been overly pessimistic over the past couple of years. This indicator is another tick in the box of keeping the Fed on hold for the foreseeable future. We're going to, well, I have a note here to talk about this later, but today is we have the Fed meeting at 2:30, and most analysts believe that the Fed's not going to do anything with interest rates today and are expecting minor cuts throughout the year, maybe two at 0.25% each for a total of 0.5%. Jobless claims we saw last week. Initial jobless claims ticked up to 223,000, while the 4-week moving average came in at 214,000, up 1,000 from the previous week. The total number of Americans receiving unemployment benefits moved up to 1.9 million, which is the highest reading since November of 2021. Our analyst take on that is a solid employment report that indicates it's getting harder to get a job, but employers aren't laying off employees already on the payroll. So this week ahead, we have the Fed meeting today. As I said, today at 2:30, the Fed interest rate decision. The central bank is not expected to move rates, and there is no dot plot at this meeting, so investors will look to the statement accompanying the decision and the chairman's press conference for clues as to where the Fed stands. Friday, we have the PCE, the Personal Consumption Expenditures Price Index. So it's referred to as the PCE or sometimes the PCE-PI report. So the PCE report is a measure of inflation in the United States. It tracks the prices of goods and services purchased by consumers. The PCE is used by the Federal Reserve to measure inflation. The Fed favored inflation reading will be closely watched after some warm inflation numbers were followed recently by slightly softer readings. Many analysts are not expecting a rate decrease, as I talked about earlier, and are projecting only 2 cuts this year for a total of a 0.5% reduction in rates. So let's talk about what happened in the markets. That's our analyst report. Let's talk about what happened in the markets this year, or last week. So the S&P 500 was up 1.76% last week, 1.1% so far for the month, and 3.80% year to date. So we're at 3.8% year to date. The S&P mid cap is at 5.01. The small cap is at 3.39. The S&P, the Russell 2000, which is also a measure of small caps, is at 3.51. And most indices are up across the board. Now, when we look at the bond index, that is just gone positive at 0.09% so far for the year. It was 0.11% over the last week. And over the past 3 months, it's down. Again, this is a bond index, is down 0.86%. So that's a snapshot of the markets as of last week. So this is the financial focus portion of the webinar. And in this section, we're going to talk about should you draw from your retirement funds to pay off debt? So as I mentioned before, I had these 2 questions recently. One had to do with credit cards and one had to do with student loans. And I know a lot of people feel a lot of debt pressure, and it can be really, you can have a lot of thoughts around, well, geez, I've got this money sitting in this IRA. Should I just cash it out and pay off this debt? I'd feel so much better about it. So I thought it would make sense to look at what the effect is on that, because sometimes, this debt can loom over. Listen, we've all been there, right? We've all had situations where we're carrying more debt than we want to, and then how are we going to pay it down? And there are things that keep us up at night. But you don't want to, risk your future for just the comfort of today. So let's look at a couple different things to pay attention to here. So we're going to look at, I'm going to explain to you a couple things. So I'm going to, when we go into the financial plan, I'm going to kind of show you how we work through these plans, just with this scenario. And we're using a sample client, and their name is Kevin and Janice Brown, completely made up. But I want you to see, what the base facts of the plans are. So the base facts mean everything as it is today. So this is the Kevin and Janice carrying this student loan of just about $50,000, and the interest rate on that is 6.5%, and that's very, very close to the prevailing rate today. I checked that, and they're looking at taking their retirement funds and paying that off. Now they're under 59.5, so that's a key item. So when you're under 59.5, you have to pay not only tax from a distribution, but you have to pay an excise tax in addition to that, and that's another 10%. So that can really have kind of a waterfall effect with things. So first of all, it drives up your ordinary income tax. That can affect things like tax credits, and they have children, so it can wipe out any kind of benefits that they get from a child tax credit. There's things that you need to pay attention to. So I first want to show the amortization schedule. So let's first look at the actual amortization schedule for this loan. So if we look at, here's where they are. They start at $50,000 in the first year, right? Here's where we are. In that first month, and every month they're paying payments, and they've got $566 coming out of their bank account. Of that, there's $271 in interest, and the rest of it is principal. But then they end up with this ending balance. So they're paying this over a 15-year period that's still left of this, and there is a balloon here at the end of that 15-year period. But this is hanging over their head, and they're saying, well, geez, instead of that, maybe they're seeing a lot of fluctuation in their retirement accounts, and they're not sure where they're going to be or how much money they're going to earn. And they say, maybe it just makes sense to pull it out, pay off this debt, and be done with it. So this can be daunting. This goes on for a long time. So we're at 2033 by the time this is paid off, and it still requires a lump sum payment, $10,513. So that means that if they wanted to continue for longer payments, they're going to pay for a longer period of time. So compare that to the amortization schedule of just a lump sum payment. Well, it's pretty simple, right? So we've got one $50,000 payment with some interest going out to pay, and then that's paid off, and now they can relax a little bit. But then, so that could make sense. You'd say, okay, that I feel much better about that. Now I can just move on with my life, and the student loan is paid off. So, but what we have to look at, what is the cost of that? So I'm going to share here. I'm going to pull down and share our financial planning portal here. So let's go through this. And this is what I'm talking about base facts. So this is a financial planning term, this base facts. So this is where you are today before any changes are made. So you can see here that we project out to age 95. And these folks already have a problem because there is a gap here. Let me just use my cursor here. There's a gap here between age 90 and age 95. So this is already a failed plan. Now, if they were clients of ours, we'd be looking to close that gap between age 90 and 95. Now, you could be glib about it and say, oh, I don't know if I'm going to live past age 90. But there's these are young folks. They're in their 30s. As they age, the probability that one of them is going to live into their 90s is much greater. So we don't want to have this gap and hope that, well, geez, they're not going to make it to age 90 and therefore they'll be okay. That's not the way to properly plan. So to begin with, there's a gap. But you'll see that they amass a good amount of money by their savings by the time that they retire. Folks, we got $7 million here. And that's through savings and investments. Now, this is just a straight line projection using some assumed rates of return. And there's some other steps we want to take from a stress test or using Monte Carlo simulations to make sure that the probability of success is at least above 82%. But if we did that with these folks today, the probability of success would probably be right around 50 because we already know that we have this gap in funding. But the importance of this illustration today is just to show you what happens if, in fact, we just take the $50,000 out of the IRA and we decide to pay off that debt. So I'm going to do this layover of this what-if scenario, and I think it might surprise you because, like I said, it frankly surprised me. So here's the base facts. So that again, that is everything that Kevin and Janice are doing to save and invest in their goals and needs and everything that they want to do when they want to retire. You can see the retirement date right here. These are Kevin's retirement, 2058, Janice's retirement, 2057. It's all worked in there. All we're changing is one thing, and we're applying this what-if scenario to pay off student loans with the IRA. Now, I want you to see what happens here. So the gray here is what used to be in base facts. The new blue here is the new amount. So I hope you can all see this well and see the numbers that are popping up. But let's look at this bottom part. So so remember that was age 90 before. Let me turn this off real quick. And we'll go back and see age 90 again, right? So assets last till age 90. And this is our baseline, right? These are our base facts. This is our baseline. So I'm now turning these things back on. We've got to pay off Kevin's student loans, and we got to cash out Kevin's IRA to pay off the loan. So now that drops the age that the funds last until age 87. 3 years they lose just by taking that $50,000 out of the IRA, paying tax, paying that additional excise tax of 10%, and losing all that potential growth down the road. The total value lost by the time that this plan is no longer funded, age 87, whether they're alive or not, the plan is no longer funded. The total value lost is $1.6 million by that decision. So this is what really shocked me when I was working on this, and I said, "Wow, that's much greater than I expected." But at age, let's just look at retirement age. So that difference there, I don't know if I can make that larger. Yes, I can. So I'm just going to make this a little larger so we can just focus on there. And let's pick a couple ages. So by 65, when they're ready to retire, getting close to retirement, that decision of taking $50,000 out of the retirement plan and using it to pay off the loan, as opposed to just paying off the loan per that amortization schedule I shared with you, even with that $10,000 lump sum paid off, at the end there, they've lost $370,000 to start to begin their retirement. As we get closer here, or as we continue, that spread widens and widens and widens, and you can see it just continues. So even if they want to be glib about it and say they're not going to live until 90, and they're thinking they're only going to live till 80 or so, and don't do that to yourself, folks, because you don't want to be in a situation where you're not doing what you want to do and taking the risk of not being able to fund your full life because of bad decisions. But at age 80, that has a negative effect of $1.1 million, and it continues to the number that we saw all the way down to 1.633 at the highest level. So holy cow. I think that illustrates really, really well that effect. I refer to them as critical items. These are critical items that maybe if you knew before, you would make decisions differently. So things I hear all the time is, I wish I would have known about doing Roth conversions, prior to today. I always say, nobody ever says, I wish I waited 5 more years. So these are things you would have done differently. Maybe you would have started conversions earlier. So tax efficient planning like that, shoring up your investment strategies, not learning how to truly protect yourself against risk. These are critical items that can make a huge difference in your retirement plan. Now, if, I'd love to get a hold of Kevin and, what the heck's her name? Kevin and Janice, in their early 30s, and be able to show them this so that I think they would make an appropriate decision being armed with this information. But most people don't have it. What most people do when they have this decision in front of them, they'll talk to their neighbors and friends who aren't necessarily qualified. Sometimes they'll find something on the internet, but you need to find qualified individuals who can help you with these kind of decisions. And even if many of you who are listening to this are probably not in your 30s. Maybe you're in your late 50s or 60s, but you may have somebody in your life who is considering making this kind of decision. And if you're a client of ours, I hope you know that we're always available for your loved ones, those in your family, those close to you. We talk to clients' children all the time because I want to avoid this for the people in our network, who are clients of ours and their loved ones. So that is a staggering difference. So I would simply say to Kevin and, oh my goodness, this Janice, Kevin and Janice, that's not something we want to do. Let's fund this to age 90, and then let's work to close the gap. So there's a lot of different things we could do for Kevin and Janice to help close that gap. We certainly have a lot of time to do that. And that would be the direction we have. But I don't know. I don't know what your thoughts are, folks. I thought that was rather shocking. That's a big difference, is that $1.6 million from that $50,000 decision at age, 33 and 34, or 32 and 33 years old. The other conversation I had was somebody said to me, so that was about student loans. And the other thing I want to point out to you is that many people they have the belief that student loans, paying off a student loan, carries the exemption of that 10% excise. And that's not true. So education expenses qualified education expenses, but student loans are not considered a qualified education expense. So you've got to, you really have to know what you're talking about, and you've got to know the people to go to for this correct information. Because if you just Google this, you're going to get conflicting information on this question, and maybe you'll find the wrong answer, and then it'll end up costing you more than you think. But the other question I had was about credit card debt. So this was student loan debt. Well, credit card debt, certainly that also doesn't. There's no exemption for the 10% penalty with credit card debt. Now you might think, well, geez, people are paying, 20%, 15% in credit card debt. That could really skew things, because the difference between the return difference, I don't know if I mentioned it, but the return difference in the example I shared with you with Kevin and Janice was 0.5%. So they were paying 6.5% in their student loan. And I just set the return for the investment at 7%. I wanted to be fair with it. Frankly, if I set it at the same amount, it's still going to have a net negative effect because of the tax amount coming out, the tax and the penalty coming out in the beginning. And the reality is, over the period of time that Janice and Kevin are investing, I would expect a much greater return, or on average of 7% a year. But back to the credit card. So some people might say, well, it's going to look much different with credit card debt because the interest rates are so much higher, and that may be true. But what I told this person who asked me this question about, and it was I'll just share with you, it was a family member, a younger family member. They said, I got this money sitting in an IRA, and we have this credit card debt. I feel like we should just cash out the IRA. They're under 59.5. Cash out the IRA and pay off this debt because we'll feel better about it. And I talked to them about how to prioritize the interest rates that they're paying their credit cards. That debt avalanche approach. And I talked to them about finding zero interest cards. And he said to me, well, actually we're doing that, where we've got most of our debt on zero interest, and we just, when that is ready to expire, we apply for another card. They have good income, they have good credit. So I said, well, just keep doing that. Just keep doing that. Make those payments. Don't add anymore, because the difference between paying tax and an excise tax and missing out on future growth compared to zero is tremendous. So if you can continue, if you're listening and your situation isn't student loans, it's credit card debt, and you have the ability to do 0% interest, there's plenty of cards out there where you can, for a period of time, you have to be careful. So these are introductory periods where you'll be able to transfer a balance of 0%, because I guess the credit card companies are hoping that you forget, or you let that introductory offer pass, and now you're paying a much, much higher interest rate. But if you do it correctly, you can just sometimes you can just renew that 0 interest, but if not, you can just apply for another credit card. So don't wait for the last minute, and don't be too, you want to have good credit, but it shouldn't be. One of the worst things I see people do is take a distribution from their retirement account to pay off credit card because they want to increase their credit score. That's just crazy. You shouldn't live and die by your credit score. You should have a good credit score, but it's not at the expense of your future retirement. So I hope that all makes sense. That was really eye-opening for me. That was a much bigger difference than I thought it was going to be. 1.6 million. And we have a question. Jerry writes, parents and grandparents may want to tap the IRAs to gift the weddings of children and not be aware of these impacts. Thanks, Mark. That's a really great question too. And these are talked about all the time. Or a great comment. Thank you, Jerry. So what Jerry's saying is that parents sometimes will say, well, I got my daughter's wedding coming up, my son's wedding coming up. I want to pull sometimes large amounts, $50,000, $100,000 out of our retirement accounts to pay for this wedding. Now, listen, when you're close to retirement or in retirement, you've got non-IRA accounts that are taxable, taxable accounts. You got tax-deferred accounts. You got tax advantage or tax-free accounts. The buckets that we do, but it's all retirement money, isn't it? I mean, this is your funds that you're living off of. So whether you're drawing out of IRAs or whether you're drawing out of Roth IRAs and not paying tax, or whether you're paying capital gains tax out of your taxable account, it's all going to affect your potential retirement longevity and comfort. So great point, Jerry. That's a consideration you want to make because we all want to do great things for our children. And I have seen people who, sometimes to the detriment of themselves, gift money to their children. So whether it's coming out of a taxable account, tax deferred account, or a tax advantage account like a Roth IRA or a cash value life insurance, consider the impact on your financial plan. And that's part of what we do for people. When we have those meetings about, we ask about your goals and needs, and we identify potential issues. We want to hear all about. It's not just, I want to spend $10,000 a month. And we work to make sure that's the right number. But also, do you want to? I want to hear about your kitchen remodel. I want to hear about maybe the additional house you want to buy. I want to hear about the weddings and other celebrations that you may want to pay for, because we want to see the effect on your financial plan. They're very, 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 very important. And we also want to optimize where those funds are coming from. So, Jerry, great point as always. I appreciate it. That's all for today, folks. It's a little early, a little more streamlined, but I hope that was helpful. I hope you can share this information with those close to you. We'll be back next week, and I look forward to seeing y'all, and I hope you have a great week. Take care. Bye-bye.